Usually when we sit down to do one of these deep dives into a famous investor, the narrative is it's pretty straightforward.
It is. It's usually a victory lap.
Total victory lap. We
Yeah.
talk about the Warren Buffetts, the Charlie Mungers, the sages of the industry who seem to have this mystical, unbreakable crystal ball.
Right. They're universally revered. Everyone agrees they're geniuses.
Exactly. The steady hands, the ones who preach value and patience and compounding. It's a comfortable story.
It's very comfortable.
But today we are looking at a figure who makes people feel anything but comfortable. I mean, she is perhaps the most polarizing figure in modern finance.
That's not an exaggeration.
Not at all. On one side of the room, you have people who have called her the absolute best stock picker of her generation, a true visionary.
And on the other side of the room, sometimes in the very same room, just a year later, you have people labeling her a massive wealth destroyer.
We are talking, of course, about Cathie Wood, the CEO and CIO of ARK Invest. And I have to be honest with you, as I was going through this stack of research, the biographies, the fund reports leading up to late 2025, the trade logs, my head was spinning a little bit.
I can imagine.
Because the data is so contradictory. I mean, how is it possible for one person to be hailed as a genius in 2020 and then just a few years later be accused of incinerating billions of dollars in shareholder value?
That is the central contradiction we have to wrestle with today. And I think if you look closely at the sources, you realize that the story of Cathie Wood isn't really about stock picking in the traditional sense.
What do you mean? It's not about PE ratios or balance sheets?
Not really. I mean, not primarily. It is a story about extreme conviction. It is about what happens when profound faith, and I mean that literally, we'll get into that, collides with high-risk technology and the brutal, unforgiving volatility of the financial markets.
It really is a roller coaster.
Yeah.
That's actually a term that pops up constantly in the commentary about our funds, a roller coaster ride.
It's the only metaphor that fits.
So here is our mission for this deep dive. We're going to try to move past the headlines and the memes. And we have to say this up front. We aren't here to give investment advice.
Please, do not take this as financial advice.
But we want to understand the mindset. We want to try and get inside the head of a woman who bets billions on a version of the future when almost everyone else is obsessing over the present.
And to do that, we have to look at her through a specific lens. I don't think you can judge her as a traditional fund manager. It just doesn't work. You have to view her as a thematic thinker.
Someone who sees patterns where others see chaos.
Exactly. Someone who claims to see the new world emerging while the rest of us are just, staring at the noise of the daily stock ticker.
Okay, let's unpack this.
Yeah.
If we want to understand where she thinks the world is going, we have to understand where she came from. And this was the first surprise for me in the research.
Oh, yeah.
I kind of assumed, given her status, that she was born on Wall Street. Upper East Side, banking family, the whole 9 yards.
Far from it.
Mm-hmm.
She starts out in Los Angeles, born in 1955.
Right, the eldest child of Irish immigrants, Gerald and Mary Deddy. And there's a specific detail about her father that just jumped out at me. I feel like this is the rosebud of the Cathie Wood story.
I know exactly what you're going to say. The radar systems engineer.
Yes. Her father served in the Irish Army and then the U.S. Air Force as a radar systems engineer.
It's a detail that seems small, but if you zoom out, it is incredibly significant. I mean, think about what a radar system actually does. What is its fundamental function?
Well, it detects things you can't see. Planes, missiles, storms on the horizon.
Exactly. But specifically, it detects things that are invisible to the naked eye. It scans the horizon for these little blips that represent something coming, something that is going to arrive but hasn't arrived yet.
And the radar operator has to trust the instrument more than they trust their own eyes.
That's the key. You have to have faith in the system, in the technology, over your immediate sensory input.
That is a fascinating connection. Yeah. So you're saying she grew up in a household where the primary mode of thinking was about seeing the invisible, about detecting the future before it becomes obvious.
I think it shaped her entire cognitive framework. I really do. She isn't looking at what a company is earning today that's visible, that's what everyone else sees. She is trying to use her own internal radar to detect where that company and the entire world will be in 5, 10, or 20 years. She is looking for the blips on the screen.
That makes a lot of sense. It explains why she seems so detached from current market conditions sometimes. When her fund is down 50% and she's on TV saying she's more confident than ever.
Right, because in her mind, the daily price is just static. It's noise. The blip on the long-range radar is the signal she cares about.
So she's in L.A. She goes to Notre Dame Academy, which is an all-girls Catholic high school. We should probably bookmark that detail about her faith. It comes up again later.
In a big way.
And then she heads to the University of Southern California, USC. And she doesn't just scrape by. She graduates summa cum laude in finance and economics in 1981.
Top of her class.
Yeah.
Clearly brilliant.
But here's where it gets really interesting. Because in academia, you often have that one professor who just changes your entire trajectory. We have to talk about her mentor.
There's still a laugher.
The Laffer curve guy. I mean, for anyone who took Econ 101, that's a name that rings a bell.
The very same. And for listeners who might not be deep into economic theory, we should probably clarify why Arthur Laffer is such a big deal. He is essentially the godfather of supply-side economics.
Right. This is the stuff that underpinned Reaganomics in the 80s.
Exactly. In the 1970s, the dominant economic theory was Keynesianism, which, to oversimplify, is the idea that government should manage the economy through spending and managing demand.
The government is the driver.
Right. Laffer flipped that completely on its head. He argued that you should focus on supply, you cut taxes, you deregulate, and you unleash production and innovation from the private sector.
The famous Laffer curve argues that if you cut tax rates from a very high level, you can actually increase total tax revenue by supercharging the economy.
Right, because more people are working, more companies are investing, the pie gets bigger for everyone. So he's all about small government, low taxes, and letting the free market run wild.
So Cathie Wood is learning at the feet of this economic rebel, really.
Absolutely. And he wasn't just her professor, he was her mentor. The sources say he took her under his wing. He actually helped her get her first job at Capital Group in 1977, even before she graduated.
Wow.
So this establishes her intellectual lineage. She isn't coming from a background of cautious, government-managed Keynesian economics. She's coming from the school of aggressive, free market, supply-side thinking from day one.
That contrarian streak we see later starts right here. She believes that innovation solves problems, not regulation.
And she believes that the market, left to its own devices, will always find the most efficient path. That is a core tenet of her philosophy that has never, ever changed.
So Laffer gets her in the door at Capital Group. She cuts her teeth there as an assistant economist. Then, in 1980, she makes the big move. She goes to New York City.
The center of the universe, for finance anyway.
She joins Janus & Associates. And she stays there for 18 years. I mean, that is a lifetime in Wall Street years.
It is. She wasn't job hopping. She settled in and wore a lot of hats there. Chief economist, analyst, portfolio manager. She really learned the business inside out.
But there is one specific moment from her time at Jennison that I think defines her entire career. It's the moment she proved her radar actually worked.
The debate with Henry Kaufman?
Yes. This is a legendary story in financial circles, to give you the context. It's the early 1980s. Inflation is rampant. Interest rates are through the roof. It's the era of stagflation.
A terrible time for the economy.
And Henry Kaufman, who's the chief economist at Salomon Brothers, was known as Dr. Doom.
Great nickname. And he had earned it.
He was a heavyweight, a giant. And his view, which was the consensus view of almost everyone on Wall Street, was that interest rates and inflation were going to keep skyrocketing. The sky was falling, essentially.
It was the only story in town. Buy gold, hide under your desk.
And here comes Cathie Wood, who is, in her late 20s at this point?
Very young, relatively unknown.
She looks at the data, specifically the money supply data she learned to analyze under Laffer, and she sees something different. She sees a blip on the radar that Dr. Doom is missing.
What did she see?
She argued that interest rates had actually peaked and were about to collapse, that the back of inflation had been broken.
Which was a completely insane thing to say at the time.
It takes some serious nerve. She's young, she's a woman in a very, very male-dominated industry, and she's standing up in meetings and telling the most respected economist in the world that he's wrong.
Publicly. She was writing reports on this.
And she was right.
She nailed it completely.
Yeah. Paul Volcker's Fed had done its job. Interest rates came crashing down. The market centered one of the biggest bull runs in history.
Imagine what that does to your psychology. I mean, really think about that formative experience.
You go against the titan, you go against the entire crowd, you trust your own niche data, and you win decisively.
It cements a belief that the consensus is often wrong. It validates the idea that if you do the work and trust your data, you can beat the market.
But, and this raises an important question, does being right once, even in a huge way, mean you're always right?
That's the danger, because that confidence, that willingness to stand alone against the crowd is a double-edged sword. It's your greatest strength and potentially your greatest weakness.
We definitely see that edge getting sharper later on. It's almost like that victory set the template for her entire career. I see what you don't.
You're all looking at the wrong thing.
Exactly. So fast forward a bit. It's 2001. After 18 years at Jennison, she moves to AllianceBernstein. This is the big leagues.
A huge, established, traditional asset manager.
And she's the chief investment officer of Global Thematic Strategies, managing $5 billion. But then 2008 happens.
The great financial crisis. And this is where we have to talk about the downsides of her strategy. This is where the cracks in the thematic approach start to show.
The sources say she was heavily criticized for underperforming the market during the crisis.
And we have to explain why she underperformed, because it's not random. It comes down to a concept called beta.
Okay, let's define that for the listener, because it's key to understanding her entire story. What is high beta?
Beta is essentially a measure of a stock's volatility relative to the overall market. The market, like the S&P 500, has a beta of 1.
So it's the baseline.
It's the baseline. If your stock has a beta of 2, it means that in theory, if the market goes up 1%, your stock goes up 2%. But, and this is the important part, it works both ways.
So if the market drops 1%, your high beta stock might drop 2% or more.
Exactly. Cathie Wood's strategies are historically very high beta. She invests in growth, in the future, in unproven tech companies that are often not profitable yet.
They are more sensitive to market mood swings.
Extremely sensitive. So when the market is happy and confident, what they call a risk-on environment, she's ecstatic. Her portfolio soars. But when the market is sad,
Or terrified, like in 2008.
she is devastated. In a liquidity crisis like 2008, investors are scrambling for safety. They don't want future promises. They want cash. They want companies that make toothpaste and toilet paper things people buy no matter what.
The boring stuff.
The boring, profitable, low beta stuff. They dump the innovation stocks first and fastest.
So her portfolio didn't just fall with the market. It crashed much harder.
Exactly. And because her strategy is fully invested in these themes, she doesn't have a safety switch. She doesn't pivot to safe stocks. She believes in her theme, so she rides the volatility all the way down.
It seems like that experience didn't scare her off, though. If anything, it seems to have made her double down on her conviction.
It's like the Henry Kaufman experience taught her to trust her gut, and the 2008 experience taught her to endure the pain when her gut feeling is out of favor.
Which brings us to 2014. She's been at AllianceBernstein for over a decade, and she has this new idea, a big idea.
She wants to create actively managed ETFs based entirely on disruptive innovation.
Let's break that down.
Yeah.
ETFs, exchange-traded funds, were mostly passive at the time. They just tracked an index like the S&P 500.
Right. Cheap, boring, and automatic.
She wanted to combine the accessibility of an ETF, something anyone can buy and sell like a stock, with her high-conviction active stock picking. She says, I want to package these high-risk, high-reward ideas into an ETF that anyone can buy.
And she pitches this to the higher-ups at AllianceBernstein.
And they said, no thanks.
They deemed it too risky, and honestly, looking at it from the perspective of a traditional conservative firm managing pension money, you can see why.
I guess so.
Active ETFs were a relatively new concept, and betting purely on the most volatile sectors of the market is inherently unpredictable. They didn't want the headache or the potential liability if it blew up.
But Cathie Wood doesn't take no for an answer. And I love this part of the story because she's 57 years old at this point.
An age when most people are planning their exit strategy.
Right. Most people at 57 are thinking about their 401k vesting and where they're going to retire. She decides to quit her stable, high-paying job as a CIO and start her own firm from scratch.
That takes guts. You can't deny that. It requires a massive, almost staggering amount of self-belief.
And she calls it ARK Invest.
Yeah.
Now, for the longest time, I assumed ARK was an acronym, like Advanced Research Knowledge or something.
A lot of people think that. Automated Risk Keeper, I've heard that one, but it's not.
It's named after the Ark of the Covenant.
The biblical ark, the one from Indiana Jones.
Exactly. The sources know she was reading the one-year Bible at the time of founding, and as she was praying and thinking about a name, the Ark of the Covenant just stood out to her.
And this reveals something absolutely essential about her character. The deep integration of her personal, devout Christian faith with her professional ambition. She isn't just managing money. She views her work through a spiritual lens.
It's so interesting because usually Wall Street is all about cold, hard rationality, atheistic numbers. But for her, there's this element of, is it destiny? Is it a calling?
I think conviction is the word we keep coming back to. If you believe you're doing something that aligns with a higher truth, or in her case, allocating capital to disruptive innovation, which she believes makes the world a better place, as God intended, you are going to hold on to your positions even when the market is screaming at you to sell.
It provides a kind of psychological armor against the critics in the downturn.
Exactly. If you think your mission is righteous, a 20% drop in a stock price isn't a signal that you're wrong. It's just a test of faith. It's the market offering you a chance to buy more of what you believe in at a discount.
Speaking of armor, and maybe a few chinks in it, we have to talk about who helped fund this launch, because launching a fund, let alone a whole family of them, is incredibly expensive. You need seed money.
Ah, yes, the seed money. This is a complicated part of the story.
The name that comes up is Bill Wang.
A name that sends shivers down the spine of risk managers everywhere now. He was the man behind Archegos Capital.
Which, for listeners who don't remember, famously imploded in March of 2021.
It didn't just implode, it vanished. It lost an estimated $20 billion in 2 days in one of the biggest, fastest trading disasters in modern history.
But this was back in 2014, before all that.
Right. Back then, he was known as a tiger cub, a protege of the legendary hedge fund manager Julian Robertson. He was known as an aggressive, high-risk investor who was also, like Cathie Wood, deeply religious.
So they connected on that level.
They did. He understood her vision, he shared her faith, and he had the capital. He provided the seed money for ARK's first 4 ETFs.
It feels like risk attracts risk. You have this high conviction, high volatility strategy, and it attracts high-risk capital.
It does. It shows the circle she was operating in. Bill Hong was known for using extreme leverage and making incredibly concentrated, aggressive bets. It's not a coincidence that this was the type of capital attracted to her vision. It kind of set the DNA for the firm right from the start. Aggressive, high conviction, high stakes.
So ARK launches in 2014. And for a while, it's a grind. They aren't an overnight success. They're out there publishing research, trying to get noticed.
For the first few years, they were a niche player. Interesting, but not exactly setting the world on fire. But then the rocket ship takes off.
The years 2017 to 2020. This is the golden era for Cathie Wood. The narrative starts to build.
Especially 2020. I mean, we all lived through it, but looking back at the financial charts from that year, it is just mind-boggling.
Her flagship fund, ARKK, the ARK Innovation ETF, was the top-performing global equity fund with over $1 billion in assets. Bloomberg named her the best stock picker of 2020.
And CNBC noted ARKK had a 170% return in just that 1 year. Let that sink in. 170%.
It's absurd. If you put $10,000 in ARKK at the start of 2020, you had $27,000 by Christmas. That is lottery ticket money.
It is. And we have to ask why. Why did 2020 happen the way it did for her? It wasn't just luck.
It was the pandemic, right? It was the ultimate catalyst for her themes.
It was the perfect storm. Think about what she was involved in. Digital payments with Square, streaming with Roku, telemedicine with Teladoc, video conferencing with Zoom, genetic sequencing, electric vehicles with Tesla.
All the things that became essential when the world shut down.
Exactly. The entire global economy was forced to accelerate into the very future she had been predicting for years. The 5-year horizon she always talks about, it arrived in 5 weeks. Her radar was perfectly tuned to that specific disaster.
She was the queen of Wall Street, an absolute rock star. Everyone wanted to know what Cathie was buying.
She had her own merchandise. People were unironically wearing "In Cathie We Trust" t-shirts.
And she was so open, right? She was democratizing the information, sharing her research freely online. It created this huge cult-like following, especially among younger retail investors.
She was appearing on every podcast, every news show. She became this icon of futuristic, optimistic investing in a very dark time.
But, and there is always a but in these stories, trees do not grow to the sky.
Right.
And 170% return is not sustainable.
No, it is not. And when the environment changed, it changed violently.
The brutal come down. 2021 hits, vaccines roll out, the world starts to reopen, and the music stops.
Well, a different kind of music starts playing. Inflation starts creeping up as supply chains are broken. And what does the Federal Reserve do to fight inflation?
They raise interest rates.
They raise interest rates aggressively. The very thing she had famously predicted would stay low back in the 80s started to rise.
And remind us again, why do high rates hurt her specific type of stock so badly?
It all comes down to a concept called discounted cash flow. It's how you value a company. If you are a company like Coca-Cola, you make a predictable amount of money today. Higher interest rates matter, but your value is anchored in the present. But if you are a tech company promising to make billions of dollars 10 years from now, those future dollars are worth a lot less today when interest rates are 5% than when they are 0%. It's a pure math problem.
So as rates go up, the present value of her portfolio's future promises goes down instantly.
The whole foundation of their valuations gets kicked out from under them, and her stocks get repriced downwards. Viciously.
ARKK falls 24% in 2021, which is not great. But after a 170% gain, maybe it's just a correction.
Yeah.
But then 2022...
The bottom falls out.
Completely. In the first quarter of 2022, ARKK was the worst performer among all the equity funds covered by the research firm Morningstar.
She went from best to worst in a little over a year.
And then comes the label that sticks. Morningstar, who are usually pretty polite, very bureaucratic with their analysis, they came out with a report in February 2024. And they didn't mince words.
They called ARK Invest the wealth destroyer.
Specifically, they ranked ARK Invest funds as the worst wealth destroyer family of funds for the entire decade ending in 2023.
That is a brutal headline.
Let's look at the specific stat here because it's staggering. Morningstar estimated a loss of $7.1 billion in shareholder value.
$7.1 billion gone.
But wait, I need you to explain this to me because this is the part that confused me at first. Looking at the data, the notes also say that for the 10 years ending in 2023, the ARK fund itself generated a total return of 122%.
That's also true.
So if the fund is up 122% over its life, how on earth can it have lost $7.1 billion for its investors? The math doesn't seem to math out.
It's a classic tragic case of the difference between time-weighted returns and dollar-weighted returns. And this is maybe the most important lesson from the entire Cathie Wood saga.
Okay, let's break that down for everyone listening.
Okay, time-weighted return is what you see on the fund chart. It shows the fund's performance over time. If you put money in on day one and never touched it, you are up 122%. Simple.
That's the theoretical return.
It's the theoretical return. But dollar-weighted return is different. It looks at when the actual dollars, the real money from real people, entered and left the fund. It weighs the returns by the amount of money invested at the time.
Ah, I see where this is going. The timing is everything.
Everything. In the early years, from 2014 to 2019, when the fund was doing well, it was relatively small. Maybe a few $100 million, then $1 billion. So a 50% gain is great, but it's not a huge dollar amount.
But then 2020 happens?
The fund goes vertical. 170% returns. It's all over CNBC. It's all over social media. Cathie Wood, the investing genius.
The FOMO kicks in, the fear of missing out.
Massively. The average retail investor sees the headline, sees the rocket ship chart, and they chase the performance. Billions and billions of dollars poured into the fund at the absolute peak. People were buying in at $150 a share in late 2020 and early 2021.
And then the elevator cable snapped.
The fund crashed all the way down to $30 or $40 a share. So most of the actual money, the bulk of the capital from the public, arrived just in time to lose 70% of its value. So the fund itself, on paper, made money over its lifetime. But the average investor in the fund got crushed. It destroyed wealth because it attracted the most capital right before it drove off a cliff.
That is a painful reality check. It's like throwing a great party, but everyone shows up 5 minutes before the cops raid the place and gets arrested.
That's a perfect analogy. The early guests had a great time, but most people just got the consequences.
And to add insult to injury, let's compare ARK's 122% 10-year return to just buying a simple tech index fund.
The NASDAQ 100 index, which holds all the big tech stocks, over that same 10-year period where ARKK returned 122% with heart-stopping, stomach-churning volatility, the NASDAQ returned 330%.
Ouch. So you took on massive stress, you bit your nails for a decade, and you ended up with significantly less than if you just bought a boring tech index fund and gone fishing.
That is the harsh truth of high-risk active management. It is very, very hard to beat the index over a long period, especially after fees.
So that puts the best stock picker of 2020 title in a pretty harsh light.
It shows that 1 year of performance means almost nothing in the long run.
But Cathie Wood is resilient. I think that's undeniable. She didn't close up shop. She didn't apologize. She kept showing up, doing interviews, and buying more of the stocks that were falling.
Doubling down on her conviction.
Let's bring this timeline up to the present day, or, well, the recent past, since we are recording this in early 2026.
Right. We have data through late 2025. And guess what? The roller coaster went back up again.
It did. After the brutal crash, ARKK rebounded significantly in 2025. Through the third quarter of 2025, the fund was up 23.4%.
which is impressive on its own, but especially impressive when you compare it to the broader market. The S&P 500 was only up about 6.8% in that same period.
So she more than tripled the market's return. She beat the market again.
She did. And this is the maddening thing about her strategy for her critics. When it works beautifully. When the conditions are right, maybe interest rates stabilized, maybe excitement around AI or crypto surged again, her high beta portfolio flies. It acts like a coiled spring. When it's released, it just explodes upwards.
Speaking of flying, there was a specific tactical move she made in mid-2025 that caught a lot of attention in the financial press, the Coinbase play.
Yes. This was in late June, early July of 2025.
So, to set the stage, Coinbase stock has surged. It was up 37% in just 1 month because there's a lot of optimism about new, clearer crypto regulation coming.
Right. And usually the criticism of Cathie is that she falls in love with her stocks and never sells. She has diamond hands, as the internet says. She just holds on for dear life.
But here, she actually took profits. She sold about $47.9 million worth of Coinbase shares, roughly 137,000 shares.
That surprises a lot of people, it seems. Disciplined.
It's very disciplined. And what's fascinating is the context. She sells into the strength, taking some money off the table after a huge run-up. But, and this is key, she didn't exit the position. She didn't lose faith.
Not at all. Even after selling nearly $48 million worth, Coinbase remained her second largest holding, making up about 8.4% of the entire portfolio.
So she's just trimming the hedges, not cutting down the tree.
Exactly. It shows active management in practice. She's rebalancing. She's saying, okay, this position grew too large relative to everything else. Let's take some chips off the table to deploy into other ideas that haven't popped yet. It contradicts the narrative that she's just a blind gambler who holds until zero.
And that sector, crypto, is a huge part of her identity now. I mean, we can't talk about Cathie Wood for more than 5 minutes without talking about Bitcoin.
It's arguably her highest conviction bet of all, even more than Tesla.
The sources say she is a major proponent of Bitcoin. But it's not just client money she's investing, right? This isn't just her playing with other people's chips.
No, this is the ultimate skin in the game. As of 2024, the records show she had allocated 25% of her personal net worth into Bitcoin.
A quarter of her personal fortune.
Wow.
That's a stunning number. I mean, most financial advisors would tell you to put, what, maybe 1% to 5% in a highly speculative asset like that?
If that, most would say zero.
If we connect this to the bigger picture, it explains why she is so immune to criticism. If you believe in something strongly enough to bet a quarter of your own life savings on it, a bad Morningstar report or some mean tweets are not going to change your mind.
She doesn't just see it as a stock. She sees Bitcoin as a monetary revolution, an insurance policy against irresponsible central banks. It's a fundamental part of her worldview.
And that ties into her politics, too. We promised we wouldn't take sides, and we won't. But we have to look at how her political views shape her investing strategy.
It's impossible to separate them. She views everything through that single lens of disruptive innovation. So naturally, she tends to view government regulation as the primary enemy of progress.
Right. Back in 2020, she publicly warned that Joe Biden's tax and regulation plans would stifle innovation. She's been very consistent on that point. Whether it's the SEC regulating crypto or proposals for tax hikes on capital gains, she sees it as a roadblock to the future she's betting on.
And she's putting her money where her mouth is in terms of education, too. It's not just about her fund. She donated a significant amount of money to her old high school Notre Dame Academy to start the Duddy Innovation Institute.
Named after her family.
Yes. And the stated goal is to encourage high school girls to study disruptive innovation. She wants to create the next generation of radar engineers, essentially.
I love that. The next generation of radar engineers. It really does come full circle back to her dad. You know, we've talked a lot about the money and the funds and the theories, but I want to take a second to look at the human side of this. She lives in St. Petersburg, Florida now, right? She moved the whole company.
She did. She moved the entire headquarters there from New York in 2021, which, again, is a classic Cathie Wood contrarian move, leaving the center of the financial universe to go to Florida.
And she's a widow. Her husband, Robert Wood, died in 2018.
And she's a mother of 3 children.
It's worth pausing on that for a moment. The year 2018, that was just before her massive rise to fame in 2020, and then the subsequent crash. She was navigating the loss of her spouse while building this empire and dealing with all that public pressure.
It speaks to a profound resilience. I mean, leading a high-risk, high-volatility fund is one of the most stressful jobs in the world. Doing it while grieving, while being a single parent, It requires a specific type of psychological fortitude.
It reinforces that idea that her faith and her deep-seated conviction are the bedrock of her ability to function under that kind of immense pressure.
It has to be.
So let's try to pull this all together. We've got the radar engineer's daughter, the mentee of the supply-side guru Arthur Laffer, the young analyst who publicly beat Henry Kaufman, the founder who named her company after the Ark of the Covenant, the best stock picker of 2020, and the worst wealth destroyer of the decade.
It is a dichotomy. It is a bundle of contradictions held within one person.
So I have to ask the big question. Is she a genius or is she a gambler?
I think? I think that's the wrong question.
Oh, okay. Then what's the right question?
I think the right question is, what is the role of active conviction in a market that is increasingly dominated by passive flows?
Break that down for me. What do you mean?
Look, the way most people invest today, the way institutions recommend you invest, is to just buy the S&P 500, buy the index, accept the market average.
It's safe, it's efficient, it works over time.
Exactly. It's the sensible path. Cathie Wood represents the old school idea, the belief that a human being, through research and insight and conviction, can identify the future and dramatically outperform the average. She's a throwback to the era of the star stock picker.
But the data we just went through shows she has struggled to do that consistently over the long haul, at least compared to something like the NASDAQ index.
True. But when she wins big. She offers a product that is fundamentally distinct. If you buy ARKK, you are not buying the S&P 500. You are buying a ticket to a very specific, concentrated vision of the future.
A future of robotaxes, genomic editing, and cryptocurrency taking over the world.
Exactly. And sometimes that vision is blurry and seems impossible, and sometimes, like in 2020, it comes into crystal clear focus. The radar picks up blips. Sometimes those blips are incoming revolutions that will change the world. Sometimes they are just noise or glitches or false signals.
And the tragedy for investors is that they often can't tell the difference until their money is already committed and the missile is already hit.
That's the risk you take.
So what does this all mean for you, the listener, trying to make sense of all this?
I think it means that conviction is a powerful drug. It can lead to massive success, like her 2020 run, but it can also blind you to risks, leading to the 2022 crash. Cathie Wood is a living reminder that the market is a humbling machine. Even the best can become the worst in the blink of an eye.
And perhaps it's a reminder that if you're going to follow a visionary, if you're going to bet on someone else's radar, you better make sure you have the stomach for the ride. And you absolutely need to know when to get off the elevator.
And maybe, just maybe, learn to check your own radar every once in a while. Don't just rely on someone else's screen.
I love that. Here is a final thought for you to mull over as you go about your day. In a world that is increasingly moving toward passive investing, where we all just buy the whole haystack instead of looking for the needle, is there still a place for the star stock picker? Or is Cathie Wood a relic of a past era, trying to use human intuition in a market that is now ruled by cold, unfeeling algorithms?
Or, here's the other side of it. Is she the only one actually looking at the long-range horizon while the algorithms are just fighting each other over the next few microseconds of trading data?
That is the multi-billion-dollar question. Thanks for diving deep with us.
See you next time.